Right now, the world's biggest tech companies are spending just, well, billions of dollars.
Yeah, absolutely billions.
Right, billions to design the next generation of blockbuster drugs. They're building these massive artificial intelligence models.
Huge models.
But there's this glaring, multi-billion-dollar problem. AI algorithms, for all their processing power, they cannot physically hold a test tube.
No, they can't.
They can't mix chemicals on a bench.
It is the ultimate bottleneck, honestly. You have the Magnificent Seven tech giants operating what we call dry labs.
Which is just, what, like a warehouse of servers?
Exactly, just warehouses of servers and brilliant software engineers, and they're trying to disrupt the pharmaceutical industry.
Right.
But eventually, I mean, that digital code has to interact with physical biology.
And that's what we're getting into today. We are looking at the microscopic, totally invisible assembly line that's stepping in to do the dirty work for big tech.
It really is a fascinating pivot.
Welcome to Talk Tickers. If you're a retail investor managing your own portfolio, you know that trying to sift through these corporate earnings calls is, well, it's often just a grueling exercise in deciphering Wall Street jargon.
Oh, the executives love their highly sanitized scripts.
They really do. They hide the actual mechanics of the business. But for this deep dive, we've got our hands on a transcript that genuinely feels like, I don't know, a glimpse into the next decade of biological manufacturing.
Yeah, today we are looking at Twist Bioscience Corporation. Ticker symbol is TWST. Specifically, we're diving into their fiscal 2026 first quarter earnings call.
And our mission here is to break this down into actionable, plain language insights for you.
Right, because what makes this particular quarter so compelling is that we're watching a company fundamentally transition.
Transition from what?
From being just a traditional biotech supplier, selling raw materials, into becoming this critical infrastructure provider for the whole AI industry.
Okay, so before we look at the financials, the revenue, the cash burn, the guidance, we need to establish the baseline of what Twist actually does.
Yeah, that's crucial.
Because if you just skim their investor relations page, you are going to get completely lost in a sea of acronyms.
No, it's alphabet soup.
So I want to break this down. Think of Twist Bioscience as a highly advanced 3D printing company. But instead of extruding plastic filament to print a little desk toy, they're printing synthetic DNA.
And the technological leap here, the core patent moat that separates them from historical biotech companies, is that they print this DNA on silicon chips.
Which sounds wild. Can you give us the historical context? Because I think for an investor to really grasp this, they need to know how it used to be done.
For sure. So for decades, if a researcher wanted to synthesize a custom sequence of DNA, the industry standard was to use a 96-well plastic plate.
Just a plastic tray.
Literally exactly what it sounds like. A plastic tray with 96 little cups in it. And you'd have machines, or even just grad students, pipetting chemical reagents into these cups to build DNA strands, molecule by molecule.
Wow, that sounds...
It was incredibly slow. It consumed massive amounts of really expensive chemicals, and the error rates are just high.
It sounds like trying to build a skyscraper using a bucket of Lego bricks.
Yeah.
Like, sure, you can do it, but scaling it up to build a whole city is going to bankrupt you.
That is the perfect way to look at it. So what Twist did was they looked at the semiconductor industry.
Okay.
They took the exact same silicon manufacturing technology that allows, Intel or Taiwan Semiconductor to etch billions of microscopic transistors onto a computer chip.
Right.
And they applied that miniaturization to wet chemistry. So instead of 96 giant plastic cups, Twist's silicon chip contains millions of microscopic walls.
Millions. So they're directing these precise chemical reactions at a microscopic scale.
Exactly. They're writing millions of distinct DNA sequences simultaneously on a single chip.
They essentially dragged Moore's law, kicking and screaming, into the biology lab.
They absolutely did. They miniaturized the chemistry. And by doing so, they drastically reduced the amount of expensive reagents they need, and they massively increased the throughput.
So they aren't just making DNA.
No, they are manufacturing it at a scale that the industry previously thought was physically impossible.
Okay, so we have a company that prints DNA on silicon chips. Let's get into phase one of our Talk Tickers structure, the headline numbers.
Let's see the data.
Right. Let's see how that technological advantage actually translated into financial performance this past quarter. If you are holding TWST in your portfolio, the very first thing you're looking for is whether the science project is actually generating sustainable revenue.
Because cool science doesn't always equal a good business.
Exactly. So in Q1 of fiscal 2026, total revenue came in at $103.7 million.
Which is a solid beat.
Yeah, that is a 17% increase year over year compared to the same quarter last year, and a 5% sequential bump from the immediate prior quarter.
And I think we need to contextualize that. In the current macroeconomic environment, we are seeing a lot of life science tools companies reporting flat or even negative growth.
Oh, totally. A lot of austerity out there.
Right. So posting a 17% top-line expansion right now, that is a very strong signal. It shows that the demand for their custom biology is somewhat insulated from those broader economic headwinds.
I mean, a 17% growth rate is great, but top-line revenue is just a vanity metric if the unit economics underneath it are broken.
Oh, absolutely.
Selling $1 for 90 cents will get you infinite revenue growth right up until the day you go bankrupt.
You'll grow yourself right into the ground.
Exactly. So let's look at the profitability picture, specifically the gross margins.
The gross margin trajectory is really where the silicon chip thesis starts to prove itself financially. Twist reported a gross margin of 52.0% for the quarter.
52%.
Yeah. And to put that in perspective for investors tracking the stock historically, that is a 400 basis point increase. So a full 4 percentage point jump from Q1 of fiscal 2025.
Wait, stop right there. Because a 4% margin expansion in a single year for a physical manufacturing business.
It's huge.
It's practically unheard of. That means for every $100 of revenue they bring in, they are keeping $4 extra before any of their operating expenses, like sales and marketing, even hit the ledger.
It is a massive efficiency gain, but, and there's the here, you have to balance that gross margin victory against their actual bottom line.
Yeah, and this is exactly where I need to step in and play the skeptic for the retail investor listening right now, because I'm looking at the rest of the income statement, and it is not all sunshine.
Not at all. Let's talk about the burn.
Right. Their adjusted EBITDA earnings before interest, taxes, depreciation, and amortization, it came in at a loss of $13.4 million for the quarter.
Right.
Yes, management proudly noted this is a $2.8 million improvement from last year. And yes, they ended the quarter with a healthy $197.9 million in cash and short-term investments. But they burned $24.8 million in operating activities to get there. Plus, they spent another $10 million on capital expenditures.
Yeah, the cash burn is the elephant in the room here.
It is a $35 million cash bonfire in a single 90-day period. So please, explain to me, why should anyone be excited about a 17% revenue growth if the company is still losing $13.4 million in EBITDA?
It's a fair question.
Because if I'm an investor, I want to know at what point the music stops. Like, when does the company have to come back to the market to issue more shares, diluting my position just to keep the factory lights on?
And that is the existential fear for literally every pre-profitability biotech investor. But management provided a specific metric on this call that directly answers your question.
Okay, let's hear it.
It requires us to dive into the concept of gross margin drop-through. This is arguably the most important number in the entire transcript.
Gross margin drop-through. Okay, let's tear this concept apart. How does this differ from the standard gross margin we just talked about?
So standard gross margin looks at the entire business, right? Total revenue minus total cost of goods sold.
Right.
But gross margin drop-through looks exclusively at the incremental revenue. So if a company generates an extra $1 million in sales this quarter compared to the previous quarter, drop-through measures exactly how much of that specific new $1 million falls straight to the gross profit line.
To cover the fixed costs of the factory.
Exactly.
Okay, let me make sure I'm visualizing this correctly. Let's say I own a factory that makes bicycles.
Okay, bicycles.
I had to spend $10 million to build the building, buy the welding robots, hire the floor manager. Those are my massive fixed costs.
Right.
But if I want to build one extra bicycle today, I only have to pay for the extra steel tubing and the rubber tires.
Yeah.
So the margin on that extra bicycle is my drop-through.
That is precisely it. And what Twist reported on this earnings call is that 74% of their incremental revenue dropped straight through to the gross margin line this quarter.
74%.
Yeah. And management also noted that their historical target range for this metric is between 75 and 80%.
Wow. So for every new incremental dollar Twist brings in right now, they only have to spend roughly 26 cents to fulfill that order?
Correct.
74 cents is pure profit at the gross level, which goes directly toward paying down those fixed operating expenses and closing that $13.4 million EBITDA loss.
And this brings us right back to why the silicon chip technology is the moat. Building the semiconductor infrastructure, developing the microscopic chemical printing processes, writing the software.
All the hard stuff.
Exactly. That was an incredibly expensive, massive fixed cost over the last decade. But now, the factory is built. The robots are online.
So adding more volume onto those chips, like printing an extra 1,000 DNA sequences for a new customer, costs them almost nothing on the margin because the machine is already running anyway.
Yes. The vast majority of the expense was just turning the machine on in the first place.
Which means the path to overall profitability isn't linear, it's exponential.
Exactly. As long as they keep layering on that 17% top-line growth quarter after quarter, the 74-cent drop-through mathematically forces them faster and faster toward breaking even.
The unit economics of the next dollar earned are just overwhelmingly positive.
Right. So Wall Street is willing to tolerate the current $13.4 million EBITDA loss because they can model exactly how quickly that gap is going to close based on that drop-through rate.
I am really starting to see why investors are sticky here. It's essentially the Amazon Web Services model applied to wet chemistry.
That's a great comparison.
When Amazon built out AWS, the capital expenditure to build those massive server farms was just staggering. But once the servers were plugged in, adding a new startup to the cloud cost Amazon pennies while they generated dollars in recurring revenue.
The AWS analogy is remarkably accurate here. Twist has built the biological server farm, the infrastructure is in place. The game now is entirely about volume.
Which naturally leads us to phase 2 of our deep dive, the story behind the numbers. Where is this massive volume of new orders actually coming from?
We have to look at the absolute crown jewel of this earnings report.
Because the headline numbers show they beat expectations, but we need to know who is buying all this synthetic biology bandwidth.
To answer that, we need to talk about the artificial intelligence tailwinds. This is the segment that proves Twist is no longer just a standard biotech supplier.
Okay, I have to admit, I am highly cynical whenever I see the letters A and I in an earnings transcript right now.
Oh, me too. You roll your eyes.
I roll my eyes. Every executive in the Fortune 500 is trying to shoehorn artificial intelligence into their prepared remarks just to get a temporary algorithmic bump in their stock price.
It's true.
You've got fast food companies talking about AI-driven drive thrusts. It is a buzzword epidemic.
Your cynicism is entirely justified. But what separates Twist from the noise is that they actually provided hard, segment-specific data to back up the narrative.
Okay, hit me with the numbers.
Their DNA synthesis and protein solutions segment, what they call DSPS, grew a staggering 27% year over year, hitting $51.1 million in revenue.
27% just in that segment.
Yeah. And if you drill down even further into that segment, the therapeutics revenue specifically spiked 39% to $37.2 million.
A 39% spike in therapeutics. I mean, that is not a buzzword. That is an explosion in real invoiced demand. So how exactly is AI driving this?
We have to look at how drug discovery is fundamentally changing. Right now, big pharma, well-funded biotech startups, and specifically the Magnificent Seven tech companies.
The big guys.
Right. They are aggressively building specialized large language models.
Right.
But instead of training these models on Wikipedia to predict the next word in an email, they're training them on biological data to predict the next amino acid in a protein sequence.
Oh, wow.
The goal is to design novel therapeutics, like custom antibodies that can bind to a specific cancer cell entirely in a computer simulation.
Okay, I follow the logic there. Because if a computer can simulate 1 billion different protein shapes in an afternoon, it's infinitely faster than a scientist doing trial and error at a lab bench.
Exactly.
But if the tech companies are designing these drugs on computers in their dry labs, why do they need Twist?
Because of the hallucination problem.
Hallucinations. Like when a chatbot confidently gives you a completely fake legal citation or just makes up a historical event.
Precisely. Now, if a customer service chatbot hallucinates, it's embarrassing.
Right.
But if biological AI model hallucinates a protein structure that actually turns out to be highly toxic to human liver cells, or it simply folds incorrectly and doesn't work,
That's a catastrophic multi-million-dollar failure.
Yes. The AI models are only making theoretical predictions. They desperately need massive amounts of physical, real-world biological data to validate those predictions, correct the algorithms, and train the next generation of the model.
So an AI can design a custom antibody on a screen, but until someone physically manufactures that exact antibody in the real world and exposes it to a real disease target in a petri dish, it's just digital science fiction.
Exactly. And the tech giants do not own wet labs. They don't have the centrifuges, the bioreactor vats, the hazardous waste disposal protocols.
They definitely don't want to deal with hazardous waste.
No. Or the armies of bench scientists required to actually build the things their computers are designing.
Let me see if I can map out this evolution in Twist's business model with an analogy, because this seems like a massive pivot.
Let's hear it.
Historically, Twist was basically a highly efficient lumberyard. A biotech company would design a genetic sequence, they'd order the raw material from Twist, and Twist would use their silicon chips to print the DNA lumber.
Right.
Twist puts the DNA in a tube, mails it to the customer, and the transaction is over. The customer then has to take that raw lumber, build the custom furniture themselves, meaning they have to insert the DNA into a cell and express the protein.
Yes.
And then they have to stress test that furniture in their own labs to see how much weight it can hold.
That is the traditional decades-old workflow of the life sciences supply chain.
But what Twist is doing now, specifically for these tech giants, is completely upending that chain. Twist is saying, you don't need to build a lab. You don't need to buy our lumber. You just send us the digital blueprint your AI designed. We will use our silicon chips to print the DNA lumber. We'll take that DNA and build the custom furniture for you. We'll express the protein in our own automated cells.
Yep.
Then we will stress test the furniture ourselves. We will run the complex biological binding assays. And at the end of the day, we won't even ship you a physical biological sample. We will just send you a PDF report and a raw data file telling you exactly how much weight the furniture held so you can feed that data back into your algorithm.
That is a phenomenal synthesis of the transcript. Twist has literally transformed from a raw material supplier into an outsourced, fully automated biological foundry.
It's brilliant.
And the data from the call supports this massive shift. In this quarter alone, Twist manufactured over 50,000 individual genes specifically for data characterization.
50,000 genes just to generate data.
Yeah, to put that in context, they shipped 271,000 genes in total for the quarter. That means nearly 20% of their entire manufacturing capacity is now dedicated not to selling physical biology, but to selling data sets.
This is a fundamental rewiring of their revenue engine.
It really is.
And this is a staggering realization for an investor. The tech industry wants to conquer biology, but they refuse to deal with pipettes and chemical spills. Twist is stepping in to be the API, the application programming interface, for physical reality.
I love that, the ATI for physical reality.
But what does this transition mean for the actual dollars and cents? Does selling a data report make more money than selling a tube of DNA?
Oh, the unit economics of this upsell are incredible. And management laid out the pricing dynamics to illustrate this. Let's look at the historical model.
Okay.
If a traditional customer wanted to buy a basic raw DNA fragment, Twist might charge them around $50.
$50.
If the customer wanted a slightly more complex, fully verified clonal gene, the price might bump up to $100. And if they needed a highly complex antibody sequence, maybe it's $200.
Okay, so $50 to $200 for the raw physical product.
But look at the new AI data workflow. If a tech company wants the full suite, meaning Twist synthesizes the DNA, expresses the protein, runs the binding assay, and delivers the validated data package, Twist can charge $300, $400, or even more per sequence.
Wow. They are essentially capturing the entire value chain that used to happen inside the customer's own R&D department.
Exactly.
They take a $50 raw material transaction and turn it into a $400 recurring data service. And because they're doing this on automated silicon chips, they can run thousands of these sequences simultaneously.
Which loops us right back to the 74% gross margin drop through we were just talking about.
Right.
The heavy lifting, the fixed cost, is handled by the platform. When an AI company places an order to validate 10,000 different protein variations, they receive their data back in 2 weeks.
2 weeks.
They feed that data into their large language model. The model learns which shapes worked and which ones failed. It generates 10,000 new, smarter variations, and the tech company immediately places another order with Twist.
It is a hyper-accelerated, highly sticky, recurring revenue loop.
Exactly. The old way of discovering an antibody using traditional in vivo animal models or manual in vitro testing, that might cost a pharmaceutical company $250,000 and take 6 months just to get a baseline read.
6 months versus 2 weeks.
Twist is allowing AI companies to do the first massive screening pass in 2 weeks for a fraction of the cost, generating the exact type of high-throughput data necessary to feed an algorithm's voracious appetite for learning.
I am thoroughly convinced the AI tailwind is not a mirage here. It is a structural shift in how biological R&D is conducted, and Twist is the toll booth.
They own the toll booth.
But as a meticulous retail investor, I cannot let the DSPS segment hog all the glory. We have to look at the other half of the business, the next generation sequencing or NGS segment. What happened there?
So the NGS Applications Group also posted a solid quarter. They reported $52.6 million in revenue, however. Management did include a rather significant caveat during the prepared remarks.
Oh boy, here we go.
They noted that excluding a single large customer who experienced a temporary pause in ordering, the core NGS business actually grew 18% year over year.
Okay, I have to throw a red flag on the play here.
I knew you would.
Whenever a management team uses the phrase temporary pause from a large customer to justify why a headline number isn't higher, my retail investor spider sense goes crazy.
It's the classic dog ate my homework of earnings calls.
It is. That is classic corporate spin for we lost a major contract, but we don't want to admit it.
It is a very valid suspicion. And the market routinely punishes stocks when customer concentration risk rears its head like this. But to be fair, the analysts on the call hammered management on this exact point during the Q&A session.
Good. And what was the defense?
Management explicitly stated that the air pocket from that single customer has already passed. The customer hasn't gone to a competitor. They merely delayed a batch of orders due to their own internal inventory management.
Right.
Most importantly, management confirmed that this customer is fully back online and the new orders are already in Twist's system as of the earnings call. The 18% underlying growth rate appears to be structurally intact.
Okay, assuming the air packet is truly behind them, I want to understand what this segment actually does. Because if the DSPS segment is printing DNA to build proteins, what is the NGS segment selling?
To understand the NGS segment, you have to understand the fundamental problem with genetic sequencing. Today, if a diagnostic company takes a blood sample from a cancer patient, they could run that sample through a sequencer and map out the patient's entire genome, all 3 billion base pairs.
Which sounds amazing, but I assume it's incredibly expensive and slow.
It is massively wasteful. If an oncologist is looking for a specific mutation in the BRCA gene for breast cancer, they do not care about the genes that determine the patient's eye color or height.
Right. That's just noise.
Sequencing the entire genome generates a massive mountain of useless data and costs thousands of dollars in computing power and sequencing chemicals.
It's like trying to find a specific recipe in a massive library, but instead of using the card catalog, you force someone to read every single book in the building from cover to cover until they stumble across it.
That is the exact problem. So Twist manufactures what are called target enrichment panels and library preparation kits. You can think of these panels as chemical search engines.
Chemical search engines, I like that. Explain the mechanics of a chemical search engine.
So Twist prints millions of tiny, specific DNA probes that are designed to physically bind only to the exact genes the doctor is looking for, say a panel of 50 known cancer mutations. The lab technician mixes Twist's chemical probes into the patient's blood sample. The probes seek out and attach themselves only to the cancer DNA. Then they use magnetic beads to literally pull those specific targeted sequences out of the sample.
Oh, that is fascinating. So they wash away all the useless DNA, leaving only the tiny fraction that actually matters.
Yes. They enrich the target. So when the lab puts the remaining sample into the DNA sequencer, the machine only has to read the relevant genes. It saves the diagnostic company massive amounts of time and sequencing costs.
So it is literally the biological equivalent of hitting Ctrl plus F on a giant PDF instead of reading the entire document.
Exactly.
As personalized medicine and liquid biopsies, where they detect cancer just from a regular blood draw, become the standard of care, the demand for these chemical search engines is going to skyrocket. Every liquid biopsy test needs a target enrichment panel.
And we are already seeing that geographic expansion in the numbers. Twist noted massive strength in EMEA, which is Europe, the Middle East, and Africa.
How much did it grow there?
NGS revenue exploded by 36% year over year in that region to $38.4 million. They also highlighted substantial growth among their OEM partners.
OEM meaning original equipment manufacturer. So other diagnostic companies are buying Twist's chemical search engines, putting their own branded labels on the boxes, and reselling them to hospitals.
Correct. It is a massive validation of the quality of Twist's underlying technology. The biggest names in diagnostics are quietly relying on Twist's silicon chips to power their own flagship products.
So the product portfolio across both AI data generation and NGS diagnostics is firing on all cylinders.
Absolutely.
But explosive growth requires capital allocation. You have to spend money to make money. And this is an area where I really want to dig into the transcript because management introduced a framework for how they're spending their cash that I think is just brilliant.
The structural versus transient framework.
Yes. They divided their investments into two distinct categories: structural investments and transient investments. Let's break this down for you, starting with the structural side.
This distinction is crucial for understanding the trajectory of their cash burn. Structural investments are permanent, baseline additions to their operating expenses.
Like overhead.
Exactly. These are strategic moves designed to capture long-term market share. The primary example management highlighted was aggressively expanding their commercial sales teams.
Which, if you follow the broader life sciences sector right now, is a wildly contrarian move.
Very contrarian.
If you look at the recent earnings calls from companies like Illumina, Thermo Fisher, or standard biotech suppliers, the dominant theme is austerity. They are restructuring, they are slashing budgets, and they're laying off significant portions of their sales force to protect their margins in a tough macro environment.
And that retreat by the competition is exactly why Twist is playing offense. They recognize a unique window of opportunity. While their competitors are shrinking their commercial footprint, Twist is structurally positioning itself to grab the abandoned market share. And the CEO noted a critical operational reality. It generally takes 1 to 2 full quarters for a newly hired salesperson to ramp up, learn the complex product portfolio, build relationships, and become fully productive.
So by absorbing the cost of hiring them right now, when macro environment is still a bit murky, Twist is laying the groundwork for a massive acceleration in late 2026 and 2027.
Right.
When the biotech funding environment fully normalizes and customers start spending aggressively again, Twist will have a fully trained, deeply entrenched army of sales reps already in the field, while their competitors will be scrambling to rehire.
It is a classic counter-cyclical growth strategy. You invest in structural capacity when it is cheapest to acquire talent.
Okay, that makes sense for the permanent structural investments.
Yeah.
What about these transient investments? What is a temporary investment in this context?
Transient investments are targeted, temporary surges in capital expenditure designed to build a specific permanent capability. Once the capability is built, the spending tapers off dramatically.
Give me an example from the call.
The standout example was a major investment in digital infrastructure. Specifically, building an e-commerce platform for their NGS business.
Hold on, wait. You are telling me that a company printing DNA on cutting-edge silicon chips did not have an online store for half of their business.
I know it sounds absurd in the age of Amazon, but yes. Management noted that historically, their original DNA synthesis products have a very mature, highly automated e-commerce portal.
Okay.
A massive fraction of their synthetic gene revenue flows through that automated system without a human sales rep ever needing to touch it. But for the NGS diagnostic tools, the chemical search engines we just talked about, they had literally 0% online sales.
0%.
Zero. Every single order had to go through a direct manual sales channel.
Let's explore why that is, because B2B medical supply procurement is notoriously archaic. If a hospital or a diagnostic lab wants to buy a panel, they aren't just clicking add to cart on Shopify.
No, definitely not.
It involves PDF catalogs, quoting processes, purchase orders, procurement department approvals, and back and forth emails with the sales rep. The friction is immense.
The friction is immense, and more importantly, the cost of customer acquisition, the C, is incredibly high. If a highly paid sales rep has to manually process a routine $5,000 order for a recurring customer every month, that rep is wasting time they could be using to hunt down a new $500,000 account.
So bringing NGS online is a massive operational lever. How are they executing this transient investment?
They hired a specialized team of outside software contractors to custom build this B2B e-commerce channel. The cost of those contractors is the transient expense dragging on the balance sheet this quarter.
Ah, I see.
In fact, they announced that they soft-launched the first phase of this digital platform just 1 week prior to the earnings call.
I see the genius here. It's like paying a massive upfront cost to a construction crew to build a toll bridge over a river. For 6 months, you are hemorrhaging cash paying the workers. That is the transient investment.
Yep.
But the day the bridge is finished, the construction crew goes home. The massive expense disappears from your income statement, but the bridge remains forever, and you just sit back and collect the tolls with practically zero ongoing friction.
Exactly. Once the e-commerce platform is fully optimized, they simply terminate the contractor contracts. The temporary drag on their cash flow vanishes, but the new, highly automated, high-margin revenue channel remains open permanently.
And it frees up the sales reps.
It dramatically lowers the friction for the customer to reorder, and it frees up the newly hired structural sales team to focus purely on high-value, complex enterprise accounts instead of doing data entry.
So we have dissected the headline numbers, we have explored the underlying story of AI data generation and NGS liquid biopsies, and we have analyzed how they are strategically deploying their cash.
For the future.
Right. This brings us to phase 3 of our analysis, management guidance. Everything we have discussed so far is a look in the rearview mirror. It provides necessary context.
But stock prices are forward-looking.
Exactly. As any seasoned retail investor knows, stock prices do not reflect the past. They are inherently forward-looking mechanisms. Stock prices are based entirely on the expectations of the future. So, what did the executive team promise Wall Street for the remainder of fiscal 2026?
The guidance portion of the call was exceptionally bullish. The executive team confidently raised their full-year outlook.
Okay, what are the numbers?
They are now officially projecting fiscal 2026 total revenue to land between $435 million and $440 million. If we look at the midpoint of that range, it represents approximately 16% annual growth.
And for the near term?
Zooming in on the immediate future for the upcoming second quarter, they guided for revenue between $107 million and $108 million.
Raising full-year guidance is obviously exactly what you want to hear. But as analysts, we need to look closer at the actual magnitude of that raise. I want to introduce a concept here that I think is vital for you to understand when you're interpreting earnings calls. We need to talk about the double the beat signal.
Oh, this is one of the most reliable tells in corporate finance.
Let's set up the psychology behind it. When a management team reports quarterly earnings, they usually either beat or miss Wall Street's consensus expectations by a certain dollar amount. Let's imagine a hypothetical company beats Q1 expectations by $3 million.
Okay.
If the CFO is naturally conservative, or if they think the $3 million was just a lucky one-time windfall like a customer pulling forward an order from Q2 into Q1, they will usually just raise their full-year guidance by that exact same $3 million.
Right. They are essentially communicating to the market, we did a little better than expected this quarter, so we will mechanically add those winnings to the final tally, but we are not changing our fundamental assumptions for how the rest of the year is going to play out.
It's a defensive maneuver to manage expectations.
Exactly.
Right. It's the corporate equivalent of hitting a jackpot on a slot machine, putting the winnings in your pocket, and refusing to increase your bet size for the rest of the night. But Twist Bioscience did something entirely different on this call.
They absolutely did. During the Q&A session, an analyst explicitly pressed the CFO, Adam Laponis, on the mechanics of their guidance raise. The CFO confirmed that they raised their full-year guidance by more than double the size of their Q1 revenue beat.
Stop and think about the implication of that. If they beat Q1 expectations by, say, $4 million, but they proactively raised the full-year forecast by $10 million, they are not just pocketing the winnings.
No, they are fundamentally accelerating their internal financial modeling for the next 9 months.
It is a massive signal of internal conviction. When a CFO commits to a double the beat raise, they are putting their own credibility on the line.
It tells Wall Street that the surge they experienced in Q1, specifically that explosion in the high-margin AI data characterization orders, is absolutely not a one-time flash in the pan.
They know it's going to keep coming.
The management team clearly has deep visibility into their future order book. They are watching these magnificent 7 tech companies consume the initial biological data, train their algorithms, and immediately return for second, third, and fourth iterations of even larger orders.
They are so confident in the stickiness of that recurring AI revenue that they're willing to literally promise it to institutional investors months in advance. You do not make that kind of promise unless the purchase orders are practically sitting on your desk.
Precisely. It de-risks the growth narrative for the rest of the year.
I agree. The revenue guidance is a massive flex.
Right.
But I'm not going to let management off the hook entirely.
I was wondering when you'd bring this up.
I had to push back hard on one specific piece of their forward-looking guidance because it is the exact kind of discrepancy that drives retail investors crazy when they're building their own financial models.
Yeah.
I want to talk about the margin choice.
Yeah, let's get into the tension between growth and margins.
Just 20 minutes ago, we were celebrating the fact that Twist achieved a 52.0% gross margin in Q1. We talked about the incredible 74% drop-through rate and how every new dollar of revenue is essentially pure profit, because the fixed costs of the silicon chips are already paid for. The math dictates that as revenue goes up, the overall margin should mechanically float higher and higher. But when management issued their guidance for the rest of the year, they only committed to keeping gross margins above 52%.
That is correct. They essentially flatlined the margin guidance.
Why? If they were already at 52% today, and revenues guided to grow 16% and drop through is 74%, the basic arithmetic says their margins should be trending toward 54%, 55%, maybe even pushing 60% by the end of the year.
Right. The math says it should go up.
Are they artificially lowering the bar just so they can easily jump over it and claim a massive victory next quarter? Is this just classic corporate sandbagging?
It's a highly critical, completely fair question. Sandbagging is a time-honored tradition on Wall Street. But on this specific call, the CFO addressed this exact mathematical tension head-on.
What did she say?
He articulated a very specific, deliberate, philosophical choice that the executive team is making regarding capital allocation. It is a choice between maximizing short-term profit optics versus maximizing long-term capacity.
I am listening. Explain the dynamic.
The CFO stated that while the underlying mechanics of the business will absolutely generate continuous margin improvements as volume scales, the company is purposefully choosing to reinvest those gains rather than letting them flow through to the final reported number.
So they're spending it before it hits the bottom line.
They're intentionally suppressing their near-term margin expansion to aggressively fund the automation of entirely new technologies.
Wait, how does automating a technology temporarily suppress the margin? Wouldn't automation improve it?
Eventually, yes. But let's look at the transition period. When Twist invents a highly complex new product, for example, a custom protein characterization assay demanded by a new AI pharma client, they initially launch that product using manual processes.
So they use humans.
Yes. They rely on their highly educated, highly paid bench scientists to literally run the pipettes and manage the experiments by hand. They do this to ensure they can deliver the critical data to the customer as fast as possible to win the account.
Okay, so the initial launch has high labor costs, which drags down the gross margin for that specific new product.
Correct. But once they prove the product works, and once they verify that the customer is going to place massive recurring orders, Twist immediately pivots. They take the gross profit they are generating from their mature products, and they spend it on capital expenditures to build custom robotics and software to fully automate the new product line.
I see the trap. During that 6 to 9 month transition period, they're getting hit with a double whammy on the income statement.
Exactly.
They're still paying the high manual labor cost to fulfill the current orders, while simultaneously spending millions of dollars on capital expenditures to build the robots for the future orders.
It depresses the blended gross margin. But once those robots come online, the manual labor is reassigned to the next new invention. The marginal cost of the newly automated product plummets to pennies, and the specific product margin skyrockets.
And management talked about this on the call.
Management explicitly stated they're in the middle of this painful but necessary transition for several critical new technologies right now, including their new rapid clip product and their massive AI data generation workflows.
So it is a highly conscious, strategic trade-off. Twist could theoretically halt all investment in new automation today. If they did that, the reported gross margin would likely instantly float up to 58 or 60%. Wall Street might cheer for a day.
But by freezing their infrastructure, they would cap their total manufacturing capacity. When the Magnificent Seven tech companies come knocking 6 months from now demanding double the volume of protein data, Twist would have to turn them away because they didn't build the robots in time.
They are sacrificing short-term margin optics to build an impenetrable moat of capacity. And this specific strategic choice led to what is unequivocally the most important quote from the entire 60-minute earnings call.
Oh, I know exactly which one you mean.
The CFO summarized their entire corporate philosophy by telling analysts, "We'd much rather build a multi-billion-dollar business at a 50+% gross margin than a $500 million business at a 60% margin."
That really is the quote of the quarter. It completely reframes the scale of their ambition.
It tells you everything you need to know about how this management team views their total addressable market. They have zero interest in being a niche, highly profitable boutique supplier. They're trying to become the undisputed monopolistic infrastructure layer for the entire biological manufacturing industry.
They want every single ounce of volume.
They do. And that aggressive pursuit of scale is exactly why the market is so laser-focused on the final and most critical piece of financial guidance provided on the call, the holy grail for Twist Bioscience.
Yeah.
Q4 break-even.
The holy grail.
For any high-growth company that has spent a decade burning hundreds of millions of dollars in venture capital and public market cash to build their foundational infrastructure, finally crossing the threshold into profitability is the ultimate existential milestone. What exactly did the CEO promise?
The CEO, Emily Leproust, was emphatic. She strictly and repeatedly throughout the call reiterated that Twist Bioscience will reach adjusted EBITDA break-even by the fourth quarter of this current fiscal year, fiscal 2026.
Did she leave any wiggle room?
None. In fact, her exact phrasing was, Q4 adjusted EBITDA break-even is a given for us now.
A given. I read dozens of earnings transcripts a week, and I can tell you that public company CEOs do not use the phrase "a given" when talking about future profitability unless their internal financial models are locked in titanium.
The legal liability of making a definitive forward-looking statement like that is immense.
It's a massive statement of confidence. And if we connect this to the psychology of the retail investor, hitting this specific target is a colossal de-risking event.
Without a doubt.
Walk us through the mechanics of that de-risking. Why does breaking even fundamentally alter how a stock is valued?
When a company is burning $25 million in cash every single quarter, the broader market inherently applies a massive discount to the stock price. It is the fear of dilution. Institutional investors look at the balance sheet and they worry, if macro conditions worsen, or if a product launch is delayed, will they run out of runway? Will they be forced to issue 10 million new shares of stock just to keep the lights on?
And every time a company issues new shares to raise cash, it dilutes the ownership percentage of every existing retail investor holding the stock. It is a ticking clock, and the market prices in the risk of that clock running out.
Exactly. But the moment a company crosses that magical threshold into sustained profitability, the ticking clock is permanently destroyed. The company becomes self-sustaining.
They wrest control of their own destiny away from the capital markets.
Yes, they can fund all of their future R&D, all of their structural sales hiring, and all of their new automation robots entirely from their own internal cash flow without ever having to beg Wall Street for another dime.
And because Twist ended Q1 with nearly $198 million in cash and short-term investments, and their cash burn is shrinking every quarter thanks to that 74% drop-through, the math clearly shows they have more than enough runway to comfortably reach that Q4 break-even point without needing a capital raise.
The financial foundation is rock solid. The dilution risk is effectively off the table, which forces analysts to fundamentally re-rate the stock based purely on its future earnings potential rather than its survival probability.
Which brings us to the fourth and final phase of our deep dive. The bottom line. We have meticulously unpacked the headline metrics. We have explored the underlying narrative of AI tech giants outsourcing their wet labs and diagnostic companies relying on Twist's chemical search engines.
We've covered a lot of ground.
We have analyzed the strategic balance between massive capacity scaling and short-term margins, and we verified the trajectory toward Q4 profitability. Now is time to take a definitive stance for you, the listener. Based on the totality of this transcript, is this a bullish or bearish signal?
When you weigh the acceleration of the AI data revenue, the structural resilience of the NGS business, the mathematical certainty of the gross margin drop-through, and the ironclad commitment to Q4 profitability, the preponderance of the evidence demands a strongly bullish stance on Twist Bioscience's trajectory.
Strongly bullish. I am in complete agreement. The underlying mechanics of the silicon platform are scaling precisely as the management team engineered them to. Let's distill this entire analysis down into 4 highly actionable, plain language takeaways for you managing your portfolio today.
Let's do it.
Takeaway number 1, the MPI engine is real and it is highly profitable.
MPI stands for New Product Introduction. What Twist definitively proved this quarter is that they do not need to invent entirely new silicon chips to maintain their growth rate.
Right, the hardware is done.
They are taking their existing massive fixed-cost manufacturing platform and simply routing entirely new high-margin software and data services through it. Transitioning from selling raw DNA fragments to selling complex AI-ready protein characterization data is a masterclass in utilizing existing infrastructure to extract exponentially higher lifetime value from the exact same customer base.
It is the AWS playbook executed flawlessly in the life sciences sector.
Right.
Takeaway number 2, the AI revenue stream is durable. This is not crypto mining 2.0.
We all remember the crypto boom where tech companies bought massive amounts of hardware, artificially inflating revenue for suppliers, only to completely abandon the infrastructure the moment the bubble burst.
Yeah, that was brutal.
This biological AI revolution is fundamentally different. Pharmaceutical companies and big tech models cannot function without physical validation. They literally cannot train their drug discovery algorithms without the real-world wet lab data that Twist generates. Twist has brilliantly positioned itself as the definitive, indispensable picks and shovels provider for the AI biology gold rush.
And as an investor, it is always infinitely safer to own the monopoly that sells the shovels to everyone, rather than trying to guess which specific pharmaceutical prospector is going to strike gold with a blockbuster drug. Takeaway number 3, counter-cyclical market share capture.
While the broader life sciences and biotech tools industry is currently huddled in a defensive posture restructuring operations, pulling back on R&D, and laying off critical sales staff, Twist is aggressively expanding its commercial footprint.
Which we discussed with the structural investments.
Right. By making those structural investments and hiring seasoned sales teams right now while talent is available, Twist is setting a trap. This counter-cyclical strategy positions them to utterly dominate the market in 2027 and 2028 when the broader macroeconomic environment inevitably normalizes and capital begins flowing freely again.
Play relentless offense while your competitors are playing defense. It is aggressive, and if they hit profitability, it is brilliant. Finally, takeaway number 4, Catalyst Watch. What is the next major event investors should have circled on their calendars?
Keep a very close eye on their upcoming Investor Day, which management formally announced will take place in May.
Why is that a big deal?
Standard quarterly earnings calls are heavily restricted. Executives generally only discuss a 90-day window. But an Investor Day is a highly orchestrated event where a company lays out its grand, multi-year strategic vision.
Yep.
The CEO explicitly promised that during this May event, they will reveal their comprehensive financial blueprint for what happens after they achieve adjusted EBITDA break-even in Q4.
That presentation is going to be fascinating to dissect, because once the existential question of survival is permanently taken off the table, the corporate conversation shifts entirely.
It absolutely does.
They stop talking about cash burn, and they start talking about capital allocation, aggressive M&A, potential share buybacks, and massive global scaling. It will literally be the roadmap for the next decade of the company's evolution.
It is the exact moment they graduate from being a highly volatile, high-growth startup to becoming an established, profitable, institutional-grade infrastructure monopoly.
We have gone deep into the microscopic weeds of the Twist Bioscience Q1 2026 earnings call today. We've talked silicon chips, gross margin drop-throughs, and biological hallucinations. But before we officially wrap up this deep dive, I want to leave you with one final provocative thought to mull over.
I'm intrigued. What is the scenario?
It's something that wasn't explicitly spelled out in the transcript, but is heavily implied by the macro trends we just analyzed. Let's circle all the way back to the image we started with, the invisible assembly line.
Okay.
Right now, big tech, the Magnificent Seven, the companies with trillions of dollars in market cap and practically infinite resources, are happily outsourcing their wet lab biology to Twist Bioscience.
Right. They're the ones ordering all the data.
They are relying entirely on Twist silicon chips to generate the vital physical data required to train their AI drug discovery models. Twist has become their de facto biological foundry.
Because, as we established, the tech giants are fundamentally software companies. They do not want to deal with the messy reality of chemistry, biological waste, and manual pipetting.
Exactly. But here's the multi-trillion-dollar existential question. As AI drug discovery matures from a neat experimental side project into the definitive foundational way that all future global medicines are created, will these tech giants truly be content to leave the actual physical manufacturing of the biology in the hands of a third-party supplier?
Wow.
Or Eventually, will an Apple, a Google, or a Microsoft decide that biology is too critical to outsource and attempt to build their own massive, fully automated proprietary wet labs to cut out the middleman and capture the entire pharmaceutical value chain for themselves?
That is the ultimate threat to the entire synthetic biology sector.
Will big tech try to insource the factory? Or has Twist Bioscience's decade of relentless capital-intensive iteration, their intricate trade secrets, and their massive, globally defended silicon DNA patent moat made them so technologically impenetrable that they have become the permanent, undisputed, and undisplaceable biological operating system for the entire technology industry?
That's the billion-dollar question.
If it is the latter, a multi-billion-dollar valuation might just be the opening act of a much, much larger story.
It is a phenomenal question, and it is definitely a thought worth exploring deeply on your own as you model the long-term 10-year potential of this specific sector.
Absolutely. Thank you for joining us for this deep dive into the sources. We hope this breakdown has helped translate the Wall Street noise into clear, actionable mechanics for your portfolio. Stay curious, keep interrogating the data, and keep your portfolio sharp.